Welcome back to the Deep Dive. We're here to break down the latest corporate developments for experienced investors, really cutting through the noise for you.
That's right. And today we're tackling Carter's Inc., ticker CRI, specifically their Q3 2025 earnings call.
It was quite the call. On the surface, maybe looked a bit mixed.
Mixed is one word for it, but honestly, reading between the lines, it felt more like a declaration of war against some really massive external cost pressures.
Yeah, definitely. So our mission today is to unpack those results, look hard at the huge margin headwinds they're facing, and figure out if this, frankly, quite aggressive restructuring plan they announced has teeth.
Is it enough? That's the key question.
Okay, let's start with that result snapshot. The headline numbers, they immediately flagged some issues, didn't they?
They really did. Adjusted earnings per share came in at $0.74. That missed the consensus estimate by about 4 cents, roughly 5%.
Okay, so a miss there. And revenue?
Revenue was basically flat, $757.8 million, so zero change year over year, just, holding steady.
But flat sales with an EPS miss. That wasn't the core problem, was it?
No, not at all. The real alarm bell, the absolute red flag, was the operating income.
Right. Adjusted operating income. It just cratered.
Plummeted down to $39 million. And remember, that's down from $77 million in the same quarter last year.
77 down to 39. Wow.
Yeah. I mean, when your operating profit gets basically cut in half while your sales are flat, you know something serious is going on with margins.
It explains that sort of defensive tone management had, doesn't it?
Completely. It confirms they're fighting a major battle against cost pressures. It felt like crisis management at points.
So that margin erosion, it leads right to the biggest culprit, right?
Tariffs. The tariff cliff, yeah. It's hitting them hard. Gross margin compressed by 180 basis points.
And that's almost entirely higher product costs.
Pretty much entirely driven by product costs, yes. And the scale of this tariff shock, you really can't overstate it.
How bad are we talking?
Well, just in Q3, the gross impact of tariffs on their margin was $20 million.
$20 million.
In one quarter.
One quarter. And you need to understand the mechanics here. It's about policy changes. Key exclusions, trade waivers, they expired.
So the safety net disappeared.
Exactly. So their new effective duty rate, it's spiking up into the high 30% range.
High 30s. What was it before?
Historically, they operated around maybe 13%. Give or take.
13 to high 30s, that's staggering. What does that look like annualized?
Okay, so management gave an updated estimate. Annually, before any mitigation, the incremental impact of these higher tariffs is now somewhere between $200 million and $250 million.
200 to 250 million.
Yep. And just for context, that upper end, $250 million, that's way bigger than their entire operating income was for all of 2024.
Good grief. So they're facing a hole larger than their recent annual profit.
It's a massive hole they have to fill, a Category 5 hurricane hitting their P&L.
Okay, so mitigation. How do you even start to mitigate something that big? You can't just find $250 million under the sofa cushions. No, you certainly can't. They're pulling multiple levers. First, credit where it's due, their supply chain team has already managed to find over $40 million in duty reductions. That's something.
Okay, $40 million clawed back. What else?
The main thing going forward, the CEO was really clear about this, is pricing.
Raising prices.
Raising prices. They see it as absolutely critical for mitigating the tariffs. The goal, or maybe the hope, is to cover the vast majority of this hit in 2026.
Through a mix of those cost cuts and price hikes.
Exactly. Price hikes are going to have to do a lot of the heavy lifting, though.
Which brings us to the restructuring. Because this tariff shock, it demanded a big response, and, well, they delivered one.
They really did. It wasn't just tinkering. It feels like a comprehensive strategic reset. They announced a plan targeting $45 million in gross annualized savings starting in 2026.
$45 million? How are they getting there?
Two main ways. First, and this is the big one, workforce reduction.
Oh, yeah.
Yeah. They're cutting approximately 15% of their office-based roles by the end of this year, 2025. That's expected to save around $35 million a year.
15% is a deep cut.
It is. Management framed it, as removing complexity, increasing ownership and accountability.
Standard corporate speak for needing to cut costs drastically.
Pretty much. But look, given that $250 million tariff number, it's probably necessary, even if it's painful.
Okay, so $35 million from headcount. Where's the other $10 million coming from?
That's coming from SG&A savings, just general belt tightening across other spending categories.
But the changes aren't just internal, right? They're also looking at their stores.
Right. Store rationalization. They plan to close about 150 stores across North America. These are low-margin stores.
150, that sounds like a lot. When are they doing this?
The target is to get up to 100 of those closed by the end of 2026, mostly just by letting leases expire.
Okay, so letting leases run out on the weekly stores, won't that hurt revenue, though?
Well, yes and no. Those 150 stores, they generated about $110 million in revenue over the last year. But crucially, they were barely profitable, maybe even losing money.
Ah, so cutting the dead weight.
Exactly. And they have data suggesting they capture about 20% of the sales from a closed store in nearby locations or online.
Okay, so you lose $110 million in low-margin revenue, but maybe keep $22 million of it through higher-margin channels, plus save on rent and operating costs.
Precisely. So the closures should actually be accretive to operating income. It's about profitability, not just top-line sales. Fewer headaches on the P&L.
That makes sense. Okay, structural changes are promising, but let's look at what is working right now. Because despite all these headwinds, U.S. retail seems to be doing surprisingly well.
It really is. That was a definite bright spot. Net sales in U.S. retail were up 3%. And that was driven by positive comparable sales growth of 2%.
And that's the second positive comp quarter in a row, right?
That's right, second straight positive quarter. And this is the absolute crucial proof point for their whole strategy.
Why is that?
Because it shows consumers accepted higher prices. Average unit retail AURs were up mid-single digits in the quarter.
Ah, okay. So they actually did raise prices, and people paid them.
Yes. It proves they have pricing power, at least in their core categories like baby and toddler, where they're still gaining market share too.
That's really encouraging evidence for them then, especially with this tariff situation.
Absolutely vital. And the momentum seems good too. They said quarter to date, U.S. retail comps are up around 7%.
7%. That's strong. But hang on. How much of this relies on everyone else raising prices too? What if, say, a big competitor decides not to raise prices and keeps promoting heavily? Couldn't Carter's suddenly look too expensive?
That is the million-dollar question hanging over 2026. It's a huge assumption baked into their plan. We'll definitely circle back to that risk.
Okay, so retail good, but offset by wholesale.
Yeah, wholesale had its challenges. U.S. wholesale sales were down. A lot of that pressure came from their Simple Joys brand, the exclusive one they do for Amazon.
Simple Joys, I remember that launch. What's happening there?
Demand's just been softening this year. And this is another area where management is making a decisive pivot.
What are they doing?
They're actively moving away from Simple Joys. You know, historically, it was almost like a private label for Amazon, probably lower margin.
Right.
Now they're shifting focus. They want to push their core brands, Carter's, Oshkosh, harder on the Amazon platform instead.
So ditching the lower margin exclusive brand to focus on their higher value core brands, even on Amazon.
Exactly. They basically admitted Simple Joys was a low margin drag. They think leaning into Carter's and Oshkosh on Amazon is actually a bigger opportunity long term.
Even if it means a bit of a sales dip in wholesale in the short term while they make that transition.
Seems like that's the calculation they're making, yeah.
And how about international? Any bright spots there?
Some resilience, yeah. Total international sales were up 5%. Mexico looked particularly strong, up 16% on a comparable basis. And Brazil, through their partner, seems to be holding up well too.
Okay, so a mixed picture across the channels. Before we get to the outlook, what about the balance sheet? All this restructuring, the tariff hit, are they okay financially?
Liquidity looks solid, actually. They reported $184 million in cash.
That's a decent cushion.
It is. But they're also being proactive. They're looking to put a new 5-year, $750 million asset-based loan and ABL in place.
Just shoring up flexibility.
Exactly. And maybe more importantly, they're looking at refinancing their existing $500 million in senior notes that are due in spring 2027.
Getting ahead of that maturity wall.
Makes a lot of sense. You know, take advantage of potentially better conditions now, lock in rates, push out the maturity. It gives them more breathing room to execute this whole transformation.
Right. Okay, so balance sheet looks managed. Let's talk outlook. Did they give formal guidance?
No, they didn't reinstate guidance, which honestly isn't surprising given the massive uncertainty around tariffs and how consumers will react to potentially industry-wide price hikes.
Seems prudent, yeah. But did they give any sense of 2026?
They did offer a preliminary view, which is really important for investors to understand. They're planning for growth next year, both sales and earnings growth.
Growth. Okay, but what's driving it?
Here's the crucial nuance. They expect sales growth to be higher than a typical year for them.
Higher than usual.
How? Mostly through pricing. Those AUR increases we talked about, not necessarily selling a lot more units.
So growth driven by higher prices, not higher volume.
That's the plan. And it hinges on that big assumption we mentioned earlier, that the whole industry raises prices to absorb tariffs, so Carter's isn't sticking its neck out alone.
A very big assumption. And that $45 million in cost savings, does that just flow to the bottom line?
Not entirely. Remember, they have that huge $250 million tariff impact. The savings are basically earmarked to help offset that, plus other inflationary pressures they're facing.
Okay.
And to fund investments. They specifically mentioned planning a nearly 20% increase in demand creation spending marketing, basically in 2026.
So the savings are paying for the tariffs, inflation, and more marketing. They're reinvesting it.
They have to. They need to keep the brand strong while navigating all this. The savings aren't just a profit boost, they're enabling the strategy.
Got it. Okay, let's switch gears. Time for our This Is Not Financial Advice segment. We take what we've heard and spin out an outrageous but plausible trade idea.
Okay, let's hear it. What's the pitch today?
All right, the pitch. Go long, Carters. CRI. But with your eyes firmly fixed on 2026 margin recovery and potential multiple expansion.
Okay, long Carters. Why now? The market reaction wasn't exactly ecstatic after the call, was it?
No, initially it focused on the Q3 pain, the margin hit, the restructuring costs. There was some selling. But look, the stock has already stabilized somewhat, and it's significantly underperformed broader retail ETFs over the past year.
So you're seeing it as a potential deep value play, a turnaround story.
Exactly. A turnaround play based on management execution. The thesis is pretty quantitative, actually.
Lay it out.
You've got $45 million in announced, concrete, annualized cost savings coming online. We've also seen proof in Q3 retail that they can push through mid-single-digit price increases.
Okay.
Combine those two, the cost cuts and the demonstrated pricing power, and you have a credible, quantifiable path to offsetting a big chunk of that tariff impact, maybe faster than the market is currently pricing in.
$45 million in cuts. What's that relative to their recent earnings?
It's nearly 15% of their last 12-month operating income. That's not insignificant.
No, that's a real needle mover if they deliver.
Right. And then add in the other pieces. If they execute well on closing those 150 low-margin stores, if they successfully pivot on Amazon away from Simple Joys towards their core higher-margin brands,
then you could see not just earnings improvement, but the market potentially assigning a higher multiple to those earnings.
That's the idea. Significant multiple repair, maybe an earnings surprise in 2026. It's a bet that management is being decisive, getting ahead of the curve here, and the market hasn't fully appreciated the potential yet.
So it's a bet on execution against a clear plan focused on levers they largely control: costs and pricing.
Precisely. It's not just wishful thinking. It's based on actions they've already announced and pricing power they've already demonstrated.
Okay, an interesting thesis. So wrapping this whole deep dive up, Carter's Q3 was undeniably tough, defined by that severe margin compression from the tariffs.
A really unprecedented hit.
But countered by some very aggressive, very decisive restructuring moves. And, crucially, that proven pricing power in their core U.S. retail channel.
Management seems willing to take the tough medicine needed to right-size the ship for this new reality.
They do. Which leads us to the final provocative thought for you, the listener, to mull over.
Go on.
This whole 2026 recovery thesis, the growth, the earnings, it leans heavily on consumers accepting higher prices across the board because competitors are raising prices too.
Right, that big assumption.
So what happens if that assumption breaks? What if we hit a weak holiday season or the economy softens further, forcing retailers back into heavy promotions? A price war scenario.
That would undermine the whole plan, wouldn't it?
It's the fundamental risk. If widespread discounting returns, Carter's ability to offset tariffs with price hikes evaporates. And that 2026 turnaround story gets a lot harder to believe. That's the key thing to watch.
Definitely something to keep a close eye on. We covered a lot today: the financials, the tariff impact, the big restructuring, the channel shifts, and that potential trade idea.
Synthesizing the call, the numbers, and management strategy against a massive headwind.
And as always, please remember this discussion is based purely on the earnings call materials we analyzed. It is absolutely not financial advice.
Thanks for tuning into the Dupe Dive.